Jacob, great to see you. Thanks very much for coming in.
James, great to be here.
Given the experience that you've got investing through multiple cycles, how would you describe or how would you characterise the current cycle we're in at the moment? Where do you see us?
Yeah, look, it's a good question. I think when you look through history, each one has that different flavour. I think in the dot-com bubble, at one point investors were discussing market cap per click as a valuation sort of metric. Fast forward to today, and we have expressions like TINA. There's everyone's sort of focused on how network effect is so important in every business model and platforms. We've got winner takes all. These types of there's all these catchphrases that evolve, and then you have the valuation metrics that seem to be specific to that cycle. So today we've got we look at lifetime customer value divided by CAC, customer acquisition cost. And you can pick holes. They're just, I think, ultimately, there's always elements of truth, and then there's mania when people start to apply them in situations maybe where they shouldn't be applied, or there's a lack of willingness to acknowledge what the weaknesses are in some of these metrics. The uncertainty about how long a customer, in many of these new businesses, how long a customer may actually hang around, or because you're really thinking about my total gross profit over this customer relationship divided by marketing costs. Well, some of those things are cyclical, they change. And by the way, there's other costs that you need to run the business other than marketing. So look, I think we, as a firm at Antipodes, we're always willing to hopefully take the kernel of truth out of some of these things, but not get carried away in the sort of, irrational extrapolation.
So are you seeing a proliferation of those reasons, those valuations, those metrics that justify?
Yeah, absolutely. I think some of them are missing the point and justifying relatively weak businesses. So it's not all cases. We're first to acknowledge that in this environment of very high P dispersion, some of the high P stocks are not going to go away, and the investment themes that are powering their growth are not going to change. But there's also going to be a bunch that have been given a free pass, because of the interest rate environment, and they've imitated disruption as opposed to being, genuinely differentiated businesses. And I think they will get found out.
We're sitting here mid-March, and it's a really interesting time. We're sort of discussing before about the debate, the contest that's going on in the market at the moment.
Yeah.
And a lot of it centres around that belief or a contention that we're going to start to see some economic growth and perhaps rising interest rates as we come out of what was a really interesting and I guess unusual year in 2020.
Yeah.
What's your central thesis on, what's your view on how things are looking from an economic perspective, and how does that feed down into sort of a central thesis that goes into your asset allocation at the moment?
Sure. Look, I think you really have to think about each of the major economies, with a slightly different sort of, through a slightly different lens. The US, let's call it China, Asia, and then Europe. So let's start with the US. What's probably more exceptional to the actual pandemic has been the policy response in the US. It's extraordinary. I mean, we have not seen this level of fiscal stimulus ever, outside of wartime. And I think the market, we're grappling with that on what that means still. And for example, it may surprise you that, there was, when you think about where consumption spend is today in the economy, it's roughly $1 trillion below trend. So Americans have under-consumed by about $1 trillion. Now, they've also been given about $1 trillion of extra income by stimulus. So their savings are $2 trillion above trend, and they have another rough, let's call it round numbers, $1 trillion coming in stimulus. So you're talking about, even if you apply a marginal propensity to consume of roughly 30%, you've got excess savings of $3 trillion. You're going to make up that underspend, in the next sort of 9 months, pretty quickly. So that's equivalent to 5% of GDP.
Well, the US are known for being great consumers, aren't they?
Sure. So it's trying to get ahead of that and thinking, where is that money going to go? Obviously, some of the savings have gone into the stock market. Some estimates are roughly, a quarter of all the stimulus checks went into the stock market. So we had the GameStop phenomenon. We had various speculative bubbles. Bitcoin. We've got sort of renewables. You name it. But thinking about how that spend plays out, that's critical, I think, for the next, let's call it next couple of years. So some ideas we have is that, look, it's very hard. Most of the underspend is really in the services sector, and it's actually hard to catch up. You can't go out and have extra restaurant meals. You only get so many holidays.
You only eat so many Big Macs.
You only get so many holidays a year. And in America, that's usually 2 weeks. So we think it could come in bigger ticket items like, durables, cars. I think you might be looking at a super cycle in US car demand. And we can go into that in a bit more detail. So, and then you've got also just the fact that markets, central bank intervention is just holding real rates very, very low across the Western world. So it used to be just Japan and Europe, and now the US has joined that brigade. Negative, the yield on the 10-year tip is negative, let's call it 60 basis points roughly. That just seems extraordinary to me, given what we think is going on in the economy. You've got this supercharged second half of the year, reopening, warming of the northern hemisphere. Case counts will be very, very low.
Vaccine rollout. Vaccines,
etc. Spending, balance sheets are really strong. They're pretty big numbers we're talking about. So the US economy will probably be roaring, but then it's the hangover. What's the hangover in the US? You've got to pay, at some point, the extraordinary fiscal deficit. You'll have higher taxes and I think higher real yields. And that will be, I think, that will lead to some of this multiple dispersion starting to contract.
So just there, that hangover period, that's 3 to 5. Is that sort of in that 3 to 5 year window?
Look, it's
hard to pinpoint.
Hard to pinpoint. You just got to keep your eyes open. I don't think there is a free lunch here. There will be higher real yields, and then taxes are going to become an issue. Corporate taxes are likely to go up, and look, let's face it. A lot of the stimulus is priced in, so it's also keeping your eyes open. I think for being selective. Pick the winners in that. That PE dispersion is giving you, I think, the opportunity to pick winners, but there's going to be lots of losers, which we can benefit from in a long-short portfolio. And then you go to China, it's the opposite. China has normalized the environment with a very moderate response. And you've got real yields of 3% in China. You've got, China's become a magnet for capital. It's competing very aggressively for global capital because it's offering such great yields. People need to keep that in their field of vision, and that, I think, puts longer-term pressure on the US dollar as the reserve currency. That's the other cost, probably high real yields, high taxes in the US, and maybe, a weaker currency longer term. So China, more normal sort of recovery, probably more flexibility in a policy sense. If there is a big hangover that hits the global economy, China, I think, has the flexibility to loosen policy.
Yeah, there's got more levers to pull.
Yeah, and so I think you play the longer game in China. It's less about rotations from value stocks to growth stocks, and more about just picking longer-term winners and not overpaying for those exposures. Exposures to services growth in the economy, consumption growth in the economy, that ongoing transition away from investment. And then Europe's always muddling through.
Well, it's got a single name, but it's not homogenous, is it?
No. It's more a federation rather than a republic. It's probably where Europe is able, I think, where the economies can catch up a little is the services sector. The services sector, there hasn't been this uber large income stimulus in Europe. Service sector is heavily biased towards tourism. So it should be able to, the service sector should accelerate. The manufacturing economy is doing quite well because it's geared towards global growth and to China. So then the question is, can Europe get an investment cycle going? Look, we think it's got a good chance of doing that around decarbonisation because it has an existing emissions trading scheme and it seems to have enough political, let's call it, cohesion to go down that path. So we can probably, we go back to that because that is, we have a reasonable exposure to in our portfolio to some of the companies that benefit from that investment spend.
What is your take on what we've seen with the recent spike up in bond yields?
Look, I'm surprised at how much media attention it's received. Given it's a move, but it's in historical context of where yields have been. It's not a particularly dramatic move. So maybe there's more pain in portfolios. That's what is being reflected in the media. So I think the issue is probably that investors are losing money on their bonds for the first time in a long time. And secondly, equities have been relatively correlated. Equities are meant to give you some protection from that, but because of the prevailing bias in equities is towards bond proxies, the market cap is now tends to be dominated by, let's call it, quality growth at a price, or in some cases at any price. Equities are becoming more correlated to bonds, which is I think a longer term issue in terms of how do you achieve downside protection, from asset diversification. There's probably a natural limit, right, where the move in bonds higher starts to choke off some of the recovery. But I don't think we're there yet, and because most of the move in the nominal bond has really been a rise in inflationary expectations, and given the economic recovery that we're seeing, I think you could justify real yields being higher, and it comes down to what you think the Fed's reaction function is. I would have thought they would want to see some normalisation in interest rate markets to potentially puncture some of the most egregious examples of speculation, before they start to discuss yield curve control. Yield curve control is quite a dramatic policy shift. And they've got to be very careful about balancing they don't want to create panic. I think normalisation in bond yields is a healthy thing if it's driven by a normalisation in the economy, which we think it is. But it will be a headwind for very high multiple stocks that maybe aren't really representative of resilient businesses.
You've mentioned it a few times, decarbonisation, and I've listened to a podcast that Antipodes put out, and you've talked about decarbonisation being mandated growth. Could you talk me through why you think it's an attractive opportunity, and particularly talk to some of the data points that you think sort of back up and reinforce why decarbonisation is an interesting opportunity for investment?
Yeah, look, I mean, when investors, given there's been a bubble in renewable stocks, maybe investors think, oh, it's too late. Look, we're really in the early innings. If you think about primary energy output across the global economy, and what are the big, we have to generate power, electricity, and then we obviously have to move things around, transport, and then we have blast energy, that we use in manufacturing. If you count all of that energy output, renewables account for about 5% of total energy output. Now, obviously, at some point, you really want to decarbonise completely, right? Over time, that's the goal. So you're talking about a multi-decade investment cycle. So we think absolutely it's going to be one of those, similar to what happened in 2000. You came out of dot-com bubble. It was a bubble in, you had that PE dispersion. Everyone was celebrating a whole bunch of new companies as winners, and a few of them did end up winning, but a lot of them disappeared. And then you had resources stocks and financials and housing stocks, which all embarked on a big super cycle. China came into the world trading system, which really led to a whole lot of investment, in structurally changed the demand outlook for resources. And the US had a housing cycle, financial cycle. By the global financial crisis, you had the market cap of the US is dominated by financial engineering, financials. It couldn't be a more different environment. So things change. And I think decarbonisation is going to drive a big change over the next couple of decades. There will be companies that emerge as massive beneficiaries of that. So we see three different ways of benefiting from this. So if we think about the US, China, Europe, they all have different incentives for decarbonisation. China, it's as much about reducing pollution from fossil fuels as it is about reducing emission, CO2 emissions. And China has a very carbon-intensive economy because it's still an economy that is investing a lot. Construction generates a lot of emissions. So the US, when they decarbonise, there's not a big multiplier on the investment because they have a big fossil fuel industry. So they're actually building a new source, clean, let's call it a renewable generation, but replacing investment in fossil fuels. Europe, you've got the best of both worlds. They're a big importer. They spend just over 1% of GDP on fossil fuel imports. And decarbonisation actually creates jobs. We think just to achieve their goals of bringing emissions down by roughly just over 50%, you're talking about over 2% additional investment for every year for the next 10 years. So you've got 2% additional investment, plus you reduce the import bill by 1% of GDP, right? So it's quite a big multiplier, for Europe, which has always been looking for a growth angle. Yeah. So I think, now it doesn't mean you have to buy European companies, but it just so happens that some of the most, let's call it advanced, or some of the best decarbonisation players do happen to be European. So,
well, talk me through an example. You've talked about some of them being out of the bubble. Clearly you found a few that you think represent good value.
Broadly speaking, Siemens is a great way, and Siemens and its subs, Siemens Energy. Siemens Energy owns Siemens Gamesa, which is the maker of wind turbines. One of the leading makers of wind turbines globally. It also has a great transmission business, so it builds high voltage transmission. It has the capacity to build electrolysis plants for making hydrogen. So grid investment is going to be one of the biggest. Building, wind and solar generation capability, and investing in the grid, and then thirdly, building battery plants so that we can build EVs. They're the three biggest areas of investment. When you think about that 2% of GDP, where's it going to go? They're going to be the three big buckets. So you've got the targeted ways of playing it, but also in Siemens, you've just got a broad proxy for investment. Siemens builds, allows you to sell software and automation gear that goes into all sorts of manufacturing facilities. And you can imagine what's going on in autos. They're rebuilding themselves. They're going away from, let's call it assembly lines that are built for internal combustion engine based manufacturing to needing battery plants and then a slightly different configuration.
Supercharged mobile phone factories.
Yeah, that's right. And so that's, Siemens is just a great proxy for that. Norsk Hydro, which is aluminium. We thought there was both a cyclical and a structural element to the story when we were looking at it initially to invest. The cyclical part of the Norsk story is simply that supply, China has always added a lot of aluminium supply, but we were looking at the rate at which supply was being added in China, and that was starting to slow down. The more structural story is, well, if you want to decarbonize, you have to adopt EVs. And if you adopt EVs, you're talking about a very heavy battery, so you have to offset weight elsewhere in the motor vehicle. And you do that by using more aluminium, to replace steel. So it's a light-weighting metal. It's very strong, but it's also very light. And so the demand profile, already roughly 25% of aluminium demand is used in transport, cars, etc. So that 25% can actually grow quite fast as you have EV adoption. And most investors aren't really thinking, they're not putting that into their demand models for aluminium. Combined with the fact that we think China is generally discouraging investments in emissions-intensive industries, whether it's aluminium or steel, we think the market's being slow to understand that some of these traditionally unloved parts of the market are actually going to go through, I think, a period of fairly strong pricing power. And it is ultimately underpinned by replacement value. If you want to build an aluminium plant from scratch and you want to do it with hydropower, if you want to do it with, which is what hydro has, if you want to make it, that's the problem with aluminium, it takes a lot of energy.
Energy intensive.
Yeah. So, we think there's lots of different ways that this investment works. It has multiple ways of winning. Finally, the third way you can think about decarbonisation, I think, is owning some of the utilities that are going to deploy the capital. In the same way that data centre stocks ended up being growth REITs or growth bond proxies, I think some of the utilities can end up being growth, as long as they're not being priced for that growth. Even in a higher rate environment, I think they can work.
I want to bring you back. I'm going to ask you for a couple of short ones to finish up on in a second. Sure. But I do want you to talk through the investment thesis behind vehicles in the US, because you talked about all of that pent-up capital that needs to get deployed, and you talked about playing it through automakers. So I was wondering if you could just explain that thesis and maybe talk about how you're playing it.
The auto space is, again, you've got Tesla at one end, and then you've just got everybody else. And I think the market cap of everybody else is less than the market cap of Tesla. So it's a good example of, once again, this sort of massive valuation dispersion in the market. We sort of, when we step back, we think about it, there's a cyclical opportunity, which I've highlighted in the case of the US. There's been, over time, an aging of the auto fleet. Now that's normal because we make cars better, they last longer. But we think that aging has probably got to the point where there is pent-up demand. The total auto output was down as a result of COVID and certain shortages. We've got semiconductor shortages. So we've almost got the perfect environment, for demand or for price. And car makers have more leverage to price. Profits have more leverage to price than volume, right? And you've had incentives that have been relatively high in the US, but you've got a shortage of supply. Automakers are just struggling to build cars because of a shortage of semiconductors. Now that will work, that's temporary, that will go away. Used cars prices are very high. Households are diverting spending from international travel to local travel. We think that will continue, even with vaccines and it opening up. I think consumers will be slow to go back to travelling. They'll jump on a plane, maybe do a domestic flight. It may take another year before they go and do the international holiday. All of that spending, those excess savings that I referred to earlier, we think there's a lot of, I think there's a very high chance that will go to upgrading the car. What about the long-term story? So the market's telling us that most of the incumbent automakers have very little terminal value, right, in the way that they're priced today. So we own VW and Honda. VW is our biggest position. We own that stock because we think the structural story is really good. Like, if you go back to Dieselgate, Dieselgate was a blessing in disguise because it forced VW to fast forward the transition, to reconsider its whole operating model. And at its core, it's embraced an early adoption of EVs. So not token EV. There's a lot of auto companies in the world today who can make an EV, but they haven't invested in a platform that they can use across all their brands in a scalable way, whereas VW has made that R&D investment and it's ongoing, and they're doing it within their existing CapEx budgets. So we think within a couple of years, there's every chance they can be making more EVs than Tesla. And we also think there's a pathway of them doing it without margins falling. We think margins could actually improve slightly as they make that transition. So they've gone all in on EVs. And then the question is, what are you paying for that exposure? In 2022, you're paying basically a forward P of 7 times. If you want to think about free cash flow yield, it's on a 10% free cash flow yield. Tesla's on a 10 times revenue multiple, not a 10 times cash flow multiple. So we think it's got loads of pragmatic value, and it's got cyclical tailwinds as well as structural tailwinds.
Thank you very much for coming in today. I know we tried to hook it up a few times last year, but it's a great time to be talking about markets, so I appreciate you coming in today.
No, it's great to be here. Thanks, James.
Thank you.